Joining us now is Bob Dahl, CIO of Crossmark Global Investments, and Mimi Duff, Senior Client Advisor at GenTrust. Good afternoon to you both. Bob, I'll start with you. It's so many cross currents in terms of the push-pull in this market between bulls and bears. What's priced in here, and is it warranted?
Great observation. The market's always uncertain, but it seems more uncertain than usual. Look at the Fed. Are they going to raise rates next? Are they going to lower rates next? There are differences of opinion there. My view is what is not priced in is a recession that we might get, and earnings estimates coming somewhat lower. The market is also pricing in, as you know, a Fed pause, as well as some cuts later in the year. The pause makes sense to me. I don't think inflation's come down enough for them to turn around and say, oh, we were only kidding, let's start lowering rates. So what's not in the market tends to be, in my view, more negative observations.
Yeah, and of course, we did get some hawkish remarks just earlier this morning from the Fed's Bowman along those lines, too. Mimi, it was a 1-2 punch from the University of Michigan Consumer Sentiment Survey today. You had a sharp drop in sentiment, and then you had a rise in long-term inflation expectations. That really pushed the reversal that we saw in stocks here today. Hard landing, soft landing, or still too soon to tell?
Well, I do think it's probably too soon to tell. Like, for the most part, we believe in Bob's thesis that stocks are probably priced a little bit too well toward a soft landing. We're expecting more of a mild recession as our baseline. And we do expect inflation to be a bit stickier. We don't see cuts in the forecast. So in particular, one of our views is that it will take a little longer for inflation to come down. And 1- and 2-year TIPS break-evens are priced for perfection. The break-evens are just south of 2%, and we don't think that inflation is going to get to that target in the next 1 to 2 years.
Okay. Bob, I mean, all this raises questions. How does earnings factor in? Because earnings season hasn't been as bad as expected. We're largely through it. Yes, we get retail results larger in a large part next week, and certainly a key read on the consumer through those. But in general, is this part of what's buoying the market here, and is that warranted?
No question it is. That is to say, first quarter earnings came in better than expected. Coming into the quarter, the guess was -5. Looks like they're going to come in at about -1. The problem, Morgan, is analysts didn't raise their full year numbers, which implies they're cutting something in the second, third, and fourth quarter. Just not enough confidence. It underscores that earnings estimates are probably still a little on the high side.
Okay. Mimi, the other piece of the puzzle here is banks. We've been asking the question day in and day out. We've seen such dramatic moves in the regional banks, and you've seen REITs get dragged down in all the turmoil and all the concern about next shoe to drop as well, too. Is this a canary in the coal mine, or is this, I keep saying this week, but is this a contagion that has already or is largely contained?
We don't think it's done. We think it's going to play out over a long time period as credit tightening is absolutely here. Banks have difficult choices to make to either raise their interest rate to keep deposits or to source funding elsewhere. As loans come due, rates are higher. So we think this is going to play out over a longer time period, and we don't think that the pressure in the banking sector is behind us.
Okay, so all of this raises the question, Bob, how does an investor position themselves right now? If you're just waking up, you're looking at the markets, you go, we got another down week. We have this wall of worry that investors are trying to climb right now. What are the best investments to make? Do you take cash out of the market, put it to the sidelines? How are you thinking about it?
So I just want to underscore, and with my answer, what Mimi just said in a different way. The Fed raised rates from 0 to 5% in a little over a year. That's drastic. The implications are we're going to have more breakage somewhere, somehow. Could it be another bank or two? Of course. Could it be a mild recession? Most likely. So I want to be careful. I want to have a little cash. I can get 4 or 5% on it. The equities I own, I want to make sure they have high predictability of earnings, not too ridiculous valuations, good cash flow characteristics. I'm trying to be a little defensive in this uncertain environment where it seems like stocks are priced for better than we're likely to get.
Yeah, you guys seem largely in agreement here. So, Mimi, quickly, I'll put the same question to you.
Very similar. We're underweight equities. We're a little bit long cash. To Bob's point, you can earn really close to 5% at this point, and we're pretty square in fixed income. We like the front end tips, and we continue to like infrastructure and just real assets in general to protect against a continued inflationary environment.